Let me be very clear. Compass will not run out of cash. It's the kind of dramatic statement you rarely see from a leader in a company-wide email. But these aren't normal times for Compass, the country's largest residential brokerage by deal volume. This week, Compass reported that it lost $101 million in the second quarter, bringing its total losses for the first half of the year to $289 million. It also slashed its revenue forecast for 2022 to between $6.15 and $6.45 billion, well below earlier guidance of between $7.6 and $8 billion. In a nutshell, continued heavy losses and a far more pessimistic outcome of the near future. Even when the housing market was going gangbusters last year, Compass managed to lose a lot of money, nearly $500 million worth. Now, faced with rising interest rates and falling home sales, it's in a pretty tough spot. Compass CEO Robert Reffkin admitted as much. Never in my time at Compass have we seen such a big downturn in such a short period of time, he said on the company's earnings call, which was filled with other hard truths for the company's agents. Number one, the firm is cutting back on one of its most popular programs, Compass Concierge, which fronts money to homeowners for repairs. It's cutting the cap on that program to $15,000 from $75,000. Now, this program has typically been seen as a nice carrot for brokers to use to win listings from sellers. Number two, it's getting stricter about commission splits. The era of brokers keeping the generous splits that they had that might have been out of whack with what Compass considers market benchmarks are gone. Instead, they'll have a year to get back to what Compass believes are the benchmarks. And number three, it's ending equity grants for new agents. Now, equity is one of the novel ways when Compass burst on the scene that they were able to lure in some top talent from across the industry. Revenues were pretty much flat. Transaction volume was pretty much flat. Now, that is impressive in a market that we're facing like this, but agent headcount was also up. It was up 22% for their principal agents year over year. Now, on one hand, that might seem like a good thing. Compass is able to attract more deal makers, but deals themselves are flat. So what you've got is really more guests at the party, but not enough chip and dip to go around. The situation's painful at other firms too, let's be clear, but none of them is losing money at the speed and scale of Compass. Now, Reffkin, in an email to agents that was seen by The Real Deal, reiterated the firm's strong financial position. He was referring to Compass's more than $430 million of cash on hand, a $300 million credit line, and very low debt. But let's just be clear, the company lost about $800 million in the last year and a half. Pointing to your cash balances in the face of such losses is like pointing to the water in a bucket, which has 5 holes in it. And there are a few burning questions we still have to answer. Number one, what happens to Compass's lease obligations? When the company was in an acquisition tear, it assumed the leases on a lot of pricey office space across the country, often paying top dollar for the privilege. It's unclear what they're going to do with some of those leases as they look to cut back on costs. Number two, is the cash on hand all theirs, or is part of it commissions that are payable to agents, i.e. money that will flow out? And number three, what is Compass's true burn rate, i.e. the amount of cash that they're losing each month? Understanding that metric is going to be key to understanding the firm's long-term viability. We'd love to have you and your voice as part of this conversation, so please leave your thoughts in the comments below. And be sure to follow The Real Deal for more residential breakdowns.